Every financial channel tells you to invest in dividend stocks, buy the high yield, collect a passive income, retire early. What almost none of them tell you is the specific mistake that causes most dividend beginners to build a portfolio that looks impressive on paper and quietly destroys their wealth in practice. And that mistake is not what you think it is. In this video, I'm going to tell you the truth about dividend investing. The algorithm does not reward people for saying. I will show you the yield trap that destroys beginners, the only dividend metric that actually matters, and what a genuinely wealth-building dividend portfolio looks like versus the kind most beginners actually build. Let me start with what dividend investing actually is. A dividend is a portion of a company's profits paid to shareholders. If you own 100 shares of a company paying $2 per share annually, you receive $200 per year just for holding the stock. The most common beginner approach is to search for the highest dividend yields possible. More yield equals more income. This logic is intuitive. It is also how most people build a portfolio that underperforms a simple index fund while taking on far more risk. The yield is not the right number to optimize for. The yield trap. Here is how it works. A high dividend yield is not always a sign of a generous, profitable company. Sometimes it is a sign of a company in trouble. Here is the math. Dividend yield equals the annual dividend divided by the stock price. Company pays $2 per share. Stock trades at $40. Yield equals 5%. Now the company runs into trouble. Stock drops to $20. Suddenly, the yield looks like 10%, extremely attractive to a beginner. But the company is in crisis. There is a real chance they cut the dividend entirely. Stock drops further. The beginner who bought for the high yield is now holding a falling stock with no dividend. This is the yield trap. It catches thousands every single year. So what is the right metric? Dividend growth rate. The number almost nobody talks about in beginner content, and the most important number in dividend investing. A dividend growth rate tells you how consistently a company has increased its dividend over time. A company paying a modest 3% yield that has grown its dividend by 8% every year for 25 years is infinitely more valuable than a company paying 10% that has never grown its dividend. Here is why. Invest $10,000 in that 3% grower. Your effective yield on your original investment after 20 years of 8% annual dividend growth is 13.93%. Your original $10,000 is now paying you nearly $1,400 per year and growing without you doing anything. Let me introduce you to the dividend aristocrats. Companies in the S&P 500 that have increased their dividend payment every single year for at least 25 consecutive years. Not maintained, increased every year for a quarter century or more. Johnson & Johnson, 61 consecutive years of dividend increases. Coca-Cola, 62 years. Procter & Gamble, 67 years through 2008, through COVID, through every recession. These companies kept raising their dividends. The fact they have done this for 60+ years reflects something real about the quality of the underlying businesses. These are not lottery tickets. These are wealth-building machines that have proven themselves over generations. Let me show you two portfolios. Same $10,000 starting investment. Same $300 monthly contribution. Both held for 30 years. Portfolio A, the beginner approach. Highest yielding stocks averaging a 9% yield with minimal dividend growth. Portfolio B, the right approach. Dividend growth stocks like SCHD and VIG, averaging a 4% yield but with consistent 7% annual dividend growth and stronger stock appreciation. After 30 years, Portfolio A has approximately $280,000 and generates $25,000 per year. Portfolio B has approximately $460,000 and generates $31,000 per year. Same money invested, 64% more wealth, 24% more annual income. The strategy matters enormously. For most beginners, the simplest approach is not picking individual stocks. It is using dividend-focused ETFs. Three of the most respected in 2026, SCHD, Schwab U.S. Dividend Equity ETF, which focuses on high-quality U.S. companies with strong dividend growth. VIG Vanguard Dividend Appreciation ETF focuses on companies with long records of increasing dividends. HDV S-Shares High Dividend Equity ETF focuses on quality high-dividend U.S. stocks. Any one of these three is a reasonable starting point. All three together give you diversified quality dividend exposure without analyzing individual stocks. Here is the honest picture for an ordinary person investing $250 per month starting today. Year 1, portfolio $3,200, annual dividends $120. Year 5, $19,000, dividends $800 per year. Year 10, $52,000, dividends $2,200 per year. Year 20, $193,000, dividends $8,000 per year. Year 30, $490,000, dividends $20,000 per year. From $250 per month, completely passively. The most common objection is that the timeline is too long. But consider the alternative. If you wait 5 years, you lose the first 5 years of compounding. You can never recover. The person who starts at 25 and the person who starts at 35 will have dramatically different outcomes at 65 from identical monthly investment. The 30-year timeline only sounds long from the beginning. In the end, it goes by faster than you think. The person who starts today will look back in 10 years, grateful they did not wait. Your action plan. Step 1. Forget yield as your primary metric. Switch to dividend growth rate. Step 2. Research SCHD, VIG-A, and HDV. Any of the three is a solid starting point. Step 3. Open a brokerage account, set up automatic monthly investment of whatever you can afford, and let compounding do the work. Drop a comment. Are you currently investing in dividends? If you have a question about getting started, leave it below. I cover viewer questions in upcoming videos. Subscribe so you do not miss it.